What's going on, guys, and welcome to today's YouTube video. And in today's video we are not going to do any analysis on Bitcoin. We are not going to do any analysis on Ethereum or any other altcoin. In today's video we are going to discuss the top 5 trading mistakes you do not want to make in order to become a profitable trader. This is something that every single trader probably has been going through on his journey to becoming profitable. This is something that I have been going through many times, and it is something that I'm still struggling with every now and then. And that is why that I want you to understand what these kind of mistakes are and how you can prevent yourself from making these kind of mistakes in the future. If you can prevent yourself from making these 5 mistakes, you're well on your way on becoming a profitable trader. These are mistakes that are often overlooked. People think that in order to become a profitable trader, you need to be very good at technical analysis, and that is something that will be coming back in today's topics. But lots of the mistakes don't revolve around technical analysis, but they revolve around completely other things that prevent you from becoming profitable. And those are the kind of things that we are going to discuss today. So get your notebook ready, write down these mistakes, write down how to prevent yourself from making these mistakes, and you will take that next step on becoming a profitable trader. Let's dive straight into it. The first mistake. This is something that every single one of you knows. Every single one of you knows this feeling of revenge trading. And what does this mean? It means that after 1 or 2 losing trades, you get this feeling, you get this urge to take the next trade as soon as possible. Not only take the next trade as soon as possible, but often take the next trade with higher risk. That brings us to the next topic, which is risk management, where I will be explaining a very good way on how to apply good risk management. But revenge trading is something that you never ever want to do. Now, how can you prevent yourself from making this mistake? It's very simple. After getting in a losing trade, you are not immediately going to find the next trade within this current area. You're not going to go on a 1-minute time frame to find any kind of quick scalp to make back your losses. No, what you're going to do is you're going to take a few hours away from the chart. This can be after 1 losing trade or maybe after 2 losing trades. But you will know when you get this feeling, when you feel this urge to revenge trade, and that should be the moment to get away from the chart for a few hours, reset your mind, reset your mood, and after you have done that, you're going to remove all of your drawings from the chart and you're going to start your analysis on Bitcoin, not on any altcoin. No, you're going to restart your analysis on Bitcoin to find some new potential trades. You're going to start on the higher time frame, and from there you're going to go on the lower time frame to potentially find some lower time frame trades. But I would suggest after 1 or 2 losing trades, first take a high probability trade. It should not have to be the next day. It can be 2 days afterwards, 3 days afterwards. But you want to make sure that after a losing trade, when you feel the urge to revenge trade, that you're going to prevent yourself of caving into that feeling. Because it's just not how it works. The market and just life in general is not going to reward you from caving into that urge of making money quick, of making back your losses quick. And that brings us to the next question, to the next topic, to the next mistake that a lot of people use, and that is bad risk management. This is something that so many of you still don't understand. So many of you still don't have a clear plan on risk management. They still don't stick to their risk management. And I've explained multiple times to you what risk management contains. You need to set a plan for yourself. And for this, I want to show you guys something that is very important. Because a lot of people, they want to make money in a quick way. They want to turn $100, $1,000 into $100,000 within a week. Is it possible? Yes, it is possible, maybe. But the chances of you losing your entire net worth, losing your entire portfolio at the time is very, very significant. Which is why you need to stick to your risk management and you need to understand the power of compound interest. Compound interest is extremely strong. And for example, what you can risk on a trade doesn't revolve around leverage. Leverage is irrelevant. What is important is the amount / percentage of your current portfolio that you want to risk when you hit stop loss. So let's say you have a $100 portfolio and you want to risk always in between 0.5 and 2% on a trade maximum, in my opinion. Obviously that varies from person to person, but in my opinion 2% is a maximum amount of risk. Now let's say you are targeting 1% gain on your account a day, which is very, very doable if you're looking for lower time frame trades as well. And at first, when you gain 1%, it's only $1, right? It's basically nothing on a $100 account. After 30 days, after the first month, you are looking at around 33.45 cents profit. Now, after 30 days of 1% gain, it should be $30, right? Because that is a 30% gain. But because of compound interest, it's not $30. It's actually over 10% higher. It's $33 plus. And that is the power of compound interest. Now, over here, at the first day when you risked 1% on the trade, it was only $1. And let's say you gained 2%, you would only make $2. Now, after 30 days, when you risk 1% on $133, it's not $1 anymore that you risk. It's $1.33 that you're risking on a trade. Which means that if you gain 2% on your account, it's not $2 anymore. No, it becomes $2.66. And that is an extra 66 cents, which is going to make you more and more profit. And this is going very, very quickly. So after 30 days, with a 1% gain on your account a day, which is doable, you're looking at a 33% increase. Now, 30 days later, your account is already almost at an 80% increase from the starting balance, because it's almost at $180, which is not twice 30% increase after 60 days, which would be $160. No, it's already $180, which is almost 15% higher. And that is the power of compound interest. And that is something that you need to understand. We can scroll back down way and way more. We can look after 1 year. 1 year of 1% gain a day. It's $3,741 approximately. That is an increase of times 37, which is crazy, right? Now you do this with $100. Let's say you do this with $1,000. We are looking at an account of $37,000, which is almost a year's salary for some people, with starting only with $1,000. And this is not a get-rich-quick scheme. This is a solid plan, solid trades, and a solid gain of 1% a day. Sometimes you will get 2% a day. Sometimes you will get minus 1% a day. But stick to that target of approximately 1% a day, and you are looking golden to make insane amount of profits. And this is something that you have to understand. This is something that if you understand this power of compound interest, it is not hard for you to stick to your risk management. But if you don't understand the power of compound interest, and if you are not sticking to your risk management, which also applies again to revenge trading, you are going to make a lot of mistakes and you're going to fuck up your account. You need to understand this. You need to put this into your brain. Okay? Now, how can you quickly calculate on how to risk 1% on a trade? Let's say you have an account balance of $1,000. I will share this crypto position size calculator in the description down below. Let's say you want to risk 1%. Entry price is $20,000 for Bitcoin, and your stop loss is at $19,000. Now, when I press calculate, it exactly calculates your position size in crypto, in this case in Bitcoin, and it exactly calculates your position size in USD. Very, very easy, very, very simple. If I apply it to 2% risk and I recalculate, it adjusts the position size for both crypto and US dollars once again. You risk 2%, which is equal to $20, and when you gain, for example, 2 RR, you will gain $40, which is equal to 4%. Understood? I think all of you understand, and now it is up to you to apply correct and solid risk management. The next one, which is not following the liquidity. This is something which is very, very important because the liquidity is provided by the retail trader. And if you are part of the retail traders, you are part of the unprofitable traders. What you want to be is part of the smart money, it's part of the market makers. Those are the kind of people that are making money, and those are the kind of people that you need to understand. And you also need to understand how retail traders think, because you don't want to enter where retail is entering. You don't want to put your stop loss where retail is putting their stop loss. Right now, when we're looking at this chart over here, where is the most amount of liquidity currently for Bitcoin? The most amount of liquidity is below this low and around this massive wick over here. I've told you guys many times, these big wicks are a big draw on liquidity. We can also see these relative equal highs over here, but this is where the most amount of stop losses are currently, and this is where the most amount of unfilled orders are. So what could be a plan of the market makers is to push the price towards those unfilled orders and stop losses, to accumulate their buy orders before targeting the stop losses and the liquidity above these relative equal highs over here. And this move over here is where the smart money makes money, and this move over here is where the retail traders are getting stopped out over here after thinking that they see a fake breakdown over here. But consolidation within a liquidity pool after a breakdown is actually a sign of strength. It's a sign of market makers accumulating positions. Retail traders and breakout traders will open shorts over here, which will add to the sell pressure, which market makers will absorb to fill their own long orders, and they will push the price back up again. So if we're quickly going to play this out, you can see they fill their orders right over here. After filling those orders, you get this squeeze towards the upside to those highs. And this is where they sell again. This is where retail traders enter a breakout trade at the top, at the resistance, and that is where the price reverses back down. Following the liquidity is an essential piece of your trading skills. If you cannot follow the liquidity, if you cannot indicate where the most amount of liquidity is, you will not become profitable. Make sure to understand liquidity, make sure to know how to identify the liquidity, and make sure to get into the brain of the market makers and the retail traders and know which side you need to pick in order to get those nice trades in. Next one, very, very simple one, guys. Too many indicators. Stop using all of these indicators. I only use two, and I only use them as extra confluence for my bias. Those are the regular RSI and the stochastic RSI. Those are the only two proper indicators that I use every now and then, and I only use them on high time frame to give me that extra kind of confirmation for my already existing bias. Price action and liquidity is king. If you cannot analyze a naked chart without any indicators, in my opinion, there's no way that you are a profitable trader. This is something that you need to understand. Every single candle is having its own story. It's either sellers being too strong or buyers being too strong, and you need to know what these kind of candles and what this price action is trying to tell you. And if you don't understand that, there's not a single indicator that will tell you what is going on. Why? Because those indicators, they are lagging. Price action is putting something on your screen, which indicators later on will translate that towards their own indicators. And you are already too late. Stop using indicators. Start with simple price action, volume level, Fibonacci retracement. Those are not indicators, those are tools. Start with liquidity, start with the trend, and you're already well on your way of making those profitable trades. Cut off those indicators, only use them as extra confluence. I have a video on my YouTube channel explaining how I use the stochastic RSI, how I use the relative strength index, and you will understand that I rarely use them. Last but not least, trading against the trend. It seems so simple, but yet again, I see so many people making the same mistakes over and over again, trading against a trend, trying to catch those falling knives. Let's take a quick example. Over here, we can see consolidation. Is there any reason to short consolidation after such a strong move down? No, there isn't. But still, so many people were entering swing shorts over here after they saw this consolidation, after this strong move up. Do we see any shift in trend on the 4-hourly time frame? No, I don't. Do we see any shift in trend on the daily time frame? I especially do not. So what happens is everyone that is opening shorts without any high time frame confirmation gets squeezed out. Now over here is where we see some distribution. Over here is where we see a break of structure. Over here is where we form a lower high, which was a potential short opportunity. Why? Because the trend was shifting on the 4-hourly time frame. So we got to move down. But now, yet again, let's go back on the daily time frame. Do we see any proper market structure shift on the daily time frame? I do not. I think now we are forming a higher low on the daily time frame, just like we have been doing over here. People were shorting over here, and now they potentially can get squeezed out again because they are shorting on a daily time frame without any daily market structure shift. But on the 1-hourly time frame, the trend obviously is different again. On the 1-minute time frame, the trend is different again. What you need to be able to do is you need to be able to identify the trend, and you need to be able to wait for those local trend shifts before entering a position. Don't trade against a trend because you will get burned. Understood? I think all of you understand. And as long as you guys understand these kind of mistakes, and as long as you guys prevent yourselves from making these kind of mistakes, you are well on your way to becoming a profitable trader. But these are 5 mistakes that I have been doing many times, that I have been learning the hard way. But as soon as I understood, as soon as I stopped making these mistakes, and like I said, yes, every now and then I still have trouble sticking to my risk management. Every now and then I still feel the urge to revenge trade. But those are the kind of moments that I step away from my screen, that I take some time off the charts, that I reset my mind before I go again. If you guys still have any questions after watching this YouTube video, if you're still struggling with certain things, certain mistakes that you're making on a daily basis, please let me know in the comments down below, and I will make sure to help you get off those mistakes. Please guys, make sure to smash up the like button for this video and to subscribe to your YouTube channel, and I'll see you guys again on Monday's video. Ciao, ciao!